progress through. As always, if you want to get on board wherever you're viewing this, YouTube, TradingView, the link is going to be under the video. Okay, http://goldstreet.io. Of course, you can join the Discord, watch my YouTube channel, Twitter, whatever it is. Just get your learning progressed. So let's go ahead. As always, any chart requests, again, under the video if you're on YouTube. If you're on TradingView, pop it on the chat box on the right-hand side. You can see it on my screen. Any chart you want to look at now or after the stream, I can cover in an informative way and a visual way. If you want to say hello and say where you're from, etc., you can also put that wherever you want. It's great to connect the trading world and see everyone from everywhere. So in regards to markets today, I've got my watch list up here and I am updating my profile. As always, I drew a very nice illustration on the gold chart at the moment. It does look like a bull and it is coming up. So you just need to know how to ride that wave, how to ride the market move to get the best result. Looking across the broad spectrum of the market at the moment, again, as I say, you haven't got too much movement on this market open, but it's much the same as I was saying before. You need to use this time wisely and you need to use it so that you'll be aware of what's coming up and what you can expect as we progress through the week. Even if you have a boring Monday, okay, markets may start to move, but nonetheless, if it is slow, it's always a good time to collect yourself and know where you're going to get, because often after prolonged periods of slow movement, you do get fast, rash moves. And if you're not ready for them, it can be really painful. So tomorrow, you've got a little bit of news, consumer confidence data for April, housing price index USA. There's a little bit here and there. And then you're going on to Wednesday with the CPI data for the Ord fairly early on. But we're just going to check over charts. Chris Shawkey, new member. Chris from Australia, I believe. Great to have you on board. Let's progress your learning. I'm looking forward to your progress. Make sure you keep me up to date. And if you're stuck at all at any time, do ask me and we'll get you running. Daniel, I'm not sure if I've seen you here before, but you want to look at the Swiss yen? That's fine. Yeah, absolutely. I'll cover that first if you like. Thanks for asking. Anyone else likewise, if you have any questions, Chris, Daniel, whomever it is, chuck them in the chat box. We'll get them covered ASAP. And of course, I can see the boost changing. If you can, press like on this, guys. It'd be really appreciated. I kicked the week off well, so everyone can get the best start possible. And the more likes there are, the more people see it. So if you can share it, like it, comment on YouTube, whatever it is, it just helps me out slightly. And I do these for free, obviously. So thanks for that. Swiss yen's an interesting one, Daniel. Thanks for asking. If I zoom way out, okay, you're hitting onto levels you've not touched on literally since 1980. Okay, it would probably be better on a yearly chart, 12 monthly. This is great because it's so helpful to look at stuff like this. You can see 1979, you get this peak. Okay, you get this candle wick here, and that's your rejection. Now, the reason why this is so good and so interesting, and if you get it right, if you get that risk management right, if you get that scaling in with DCA accurate, and you understand what it is to be an accurate trader and get a good price in the markets, then you're going to find that the fall, okay, just like you had here, is enormous. Okay, now let me just draw it a little bit better, because you can get some better arrows on here, can't you? If you look at that fall here, okay, so you go from 151, just up here, pretty much where we are now, 1513, and you can see, okay, in that year, you go to 113, 151 to 113. It's that candle I'm referring to right here. Now, that is an astonishing fall. Now, if you're sat and you're looking at this, okay, is going to do the same thing eventually. You will have an enormous fall. And it's just the way things go. This is just basically going to have to repeat, because eventually positions will be liquidated at an extremely high and unsustainable price. and you get those big falls. That's how markets work. But the question is, of course, for every trader who tries to trade things like this is, how am I going to get from this point to that point safely? Okay. Now, I think it's likely you'll pull to here with a minor bounce at here, because this level that I've just drawn, okay, I'll draw that a bit better as well. This candle wick, the top of that, is going to be your first reference point for exits, because it's the only thing you can actually see. If you look to the left, it's the only thing in between this gap, okay, that has any relevance. And that's because it's where orders are going in and out of the market. And that's why you get a candle wick, because people have liquidated their positions before, okay, and that resistance, if you like, that got blown through becomes support again. Now, what's significant as well, and what will aid you in your quest to trade this, is looking at that candle wick that's just come there. You can see this one I'm referring to. So this year, the price comes up and you'll notice it pulls away, but it only pulls away more or less as far as that wick, and it goes back up. So that's showing you that there is still strong PA, still strong buyers, strong price action to the upside. But again, the question remains, how are you going to trade it safely so you can keep your equity in a safe way and catch that enormous fall? And being a trader, being a successful trader, is all about that. Okay, it's about trading safely. Okay, safe equity / risk, catch, move. Those two come hand in hand. If you can get the first one right, you can get the second one right. Now, the problem lots of traders actually have is that they do not do part one. Okay, so that means they will over leverage, okay, or they'll bunch up. And what I mean by bunch up is they'll short here, okay, 114, let's say, and then they'll short again immediately, and then they'll short again. So their DCA is far too tight, okay? It's far too tight, and often as well with being tight, okay, with a really small range, that's a problem, because their drawdown is going to raise too quickly. So they won't have safe equity and they won't be low risk. So the way you do this is you need to space that DCA out. Don't bunch your positions, okay? Space it out, because your risk is going to be substantially lower. Now, with that, you need appropriate risk sizes and the distance between your DCAs, okay? That's what you'll get in this link here, okay? And my members have got that now, like Chris. But these need to be spreaded out, because if they're too close, the drawdown becomes unsustainable. Okay? And that's a problem, because if your drawdown's unsustainable, you're never going to catch a move like this. You won't get to that point because you'll bust out. You'll get a margin call. So the way to trade these extreme market moves, okay, is to understand, I mean, this high is likely to be beaten because you can see how strong that candle is. So therefore, if you're thinking, okay, well, I want to get short again, you might consider spacing it out. Now, another good thing to do is look for levels that you can see previously. Okay, so that could mean dropping to the weekly, but regardless, anything up here is going to be a short. And the reason why is because, you know, factually, we can both agree on this, that price is where people sold. And it is, because the price comes down. That's a non-negotiable fact. People sold at this point, and therefore you have to understand as a trader, what are they going to do when you come back to that same area? Given they've sold once already, and the market is built on areas where people buy and sell continuously, okay, even as recent as here, you can see that with your fall to early support. You know, therefore, that when you rise to that same level I've just referred to, okay, up here, that it's going to be short again. So instead of shorting like here and then immediately after, you might consider just not shorting until you get to 154. And if you don't get to 154, you could start to trade it on the move down. So let's say you got to 1529, you might have a pullback like that, and then a pullback into that area, and you can reshort. So if you don't get the first move, no problem. You can reshort. And it's all about, can I last as the price comes up away from these MAs? Can my drawdown sustain it? Now, of course, within my academy as well, you have hedging methods to basically mitigate any loss when the market moves sideways. So if you started shorting all the way up and you've said, okay, well, I'm not going to short anymore and I need to control my risk, you could have spent from June 2022 to April now hedging all of this. Okay, you could have hedged it for months and you could eradicate any trade you got wrong. And that is what I teach people because it's a little bit more advanced. But basically, if you're more new, just let the market do its thing. Let it run. Refer to previous highs where people have obviously sold in the market and look to get short. Okay, especially when your fall from this level is so near and the candle going back in is so strong, there's a good chance that you will get that 154 area. And because your size is going to be small, remember, we're not going to do massive sizes because we're DCAing, okay? Because your size is small, and if you're hedging, perhaps, then your risk is not going to be unsustainable, okay? Daniel, absolutely. I hope it helps. No problem. Of course, as I say, if you want to start, you can do that there, and you'll get the tools for this. I'm looking for a short order this week. Can you check US dollar CAD? Thank you. Chris as well, Euro US dollar. Absolutely. Let me just cover the US dollar CAD and I'll come straight to that. Thank you for requesting. So, Daniel, specifically, if you look at this movement, okay, so you've got sideways October 22 all the way to April 23 now. 6 months of sideways movement, a little bit like what you just saw a second ago on the Swiss yen. If I drop to the weekly, again, you can see that more clearly. So you've got this sideways or slightly to the downside. I mean, pretty much the best way to look at it is like this because it's very, very tight. But you get this a lot in markets, especially when they stall. If you look how I'm drawing these lines, now everyone in my academy and who follows me knows I'm not a breakout trader. We're not doing this to catch breakouts. We're doing it so you can understand that the price is slowly getting closer and closer, okay, like a snake. And it's because the market can't decide what way to go. So if you are going to short this, it's going to need to be in line with that movement. And again, with my tools, you'll be able to measure a trend within this and trade it more accurately. But anything in there is going to constitute a light short for me. And it's light because the margin's getting tighter and the risk is higher. Okay. So lightly short, I like it, 1363. Again, I'm just following that movement along. So that's the dollar CAD. I don't really give signals. I mostly teach people, but that's what I think on that. Chris, euro dollar. I've drawn this already on here. Now, you can really track the movement here, and it's great because it links a little bit in with the Swiss yen as well. So this live stream is going to be more or less about catching moves after sustained moves up and how to scale into that market so that you're not picking the wrong point, if you like. Nobody is going to get a 100% accuracy rate. It doesn't exist. And it's not your job to be that guy. Or that lady. You don't need to be someone who can. I don't pick markets 100% of the time, but I still make money. Okay, and that is the point. You don't need to know anything for certain, as the great Jesse Livermore said. You don't need to know anything for certain. You just need to, you just need to make money. You don't need to know what is going to happen exactly. You just need to be making money from the moves. So you don't have to be right 100% of the time. Now, a good demonstration of that is what I've drawn here. The market's gone sideways, okay, and you've got a good short zone at 1116, okay. If it's not 1116 and it's 1126, it's not going to matter because my size and my risk plan is going to be very accurate, okay, or it's going to be sustainable, more or less. And again, as long as you're a sustainable trader, it's not going to matter whether you get it right 100% or not. So for the euro dollar, you've come up and up and up. Then you have a dip for long 2. Then it comes up. We're not buying because you've got no dip. Okay, no dip equals no buy. And that's a natural way to trade. That generally, as a consensus, is a rule. There's no dip, then you don't buy, because if there isn't a dip, you're buying a high price. In other words, you've gone long March 23, come up, you're out for gains. You only want to buy if you can get back. Okay, if you don't come back, you're not buying. So again, as you rise up to these higher levels, like on the Swiss yen, you're looking short. Okay, and looking short, and that's how you're going to handle things. I mean, you can very, very lightly short 110.4, but mainly for most traders on a risk-averse scale. In other words, you know, you're relatively new. You might not be aboard my academy. You might not have a strategy. You'd be looking short safely or more safely at 116. It's not financial advice, obviously, but generally, if the price is higher, then it's a safer trade because you have more margin. And if you just look at your stochastic oscillator, much like your Swiss yen again, it's far, far high. So again, you don't want to be buying. That represents no dip. You can see there's no dip there. Otherwise, it would look like that. Not always, but most of the time. So if we were long, is it getting close? If you were long, Chris, you should be out of it now. Okay? You should be exiting that now because there's no point in holding after all of this. Take the money and then re-long on a fall and take the money again. And take the money and take the money and take the money. Keep pulling it out. Trade in stages. Okay, like you can see here, you've got short and then you get a pop up and then you get short. Okay, and then you get a pop up and then you get short. It's not one trade, it's various trades. And that's how you need to do things, because if you just swapped your monthly, you can see that you've come all this way and you're all the way up here. It's an enormous move. Now, this is bound to, again, like the Swiss yen, fall away eventually. And the longer you hold the trade, the more likely that gets. That's why we kill it off. Looking at short side in short time frame, it's short on all time frames pretty much. If we were long, like I said, you take the profit. So I think what you're probably referring to, yeah, exactly. I mean, on the hourly, you've got a very light uptrend. Okay, you're coming to the upside of it again. If you're going to short it, you really want to do it lightly. But like I said, for risk-averse traders, which suits the majority of people on TradingView, it's safer at this point, 1116, 1117. And it's because you coincide with your 200 MA. And if you put your chart to the monthly and you look to the left-hand side, you can see there's been various points of rejection now and various points of rejection previously at 1117 area. Okay, so the first level, which I've referred to, where there is minor rejection, has already been hit. So eventually that will break through. So that's why we dropped the size. But the one above it has not. Okay, so that's why it would be a risk-averse zone, because there's inherently less risk at that point than there is here. Okay, because you've hit it once already. Trades, welcome back. Oil, I hope that covers that for the euro, Chris. If it doesn't, you feel free to DM me wherever else, or I can do it on here. That's no worry. If it's more specific and you want to type it out, send it to me now, and as soon as I finish this, I'll draw it for you and send it to you. And that's what you get as a full member, as you'll see. So US oil, let's go for that. Thanks for the question again. I did look at this a few times. I'm not comfortable long here. Okay, you've not quite filled the gap. I'd like it further down. I'd much prefer it down here. And the reason why is because if you look again, you've got that rejection. Okay, so thinking to yourself, on a fall, where would I really like to get it long? Would I like to get it where there isn't much of a dip? It's not an enormous dip. Or would I like it if I can extend lower? Okay. And it's much more feasible, 74 for me at this current point. And again, we're looking to catch that market move as long as there's a sustainable dip, and we can then have a sustainable size accordingly to suit drawdown should we get that trade wrong. Okay, because we're not right 100% of the time, but we don't need to be to make money. We're right a lot of the time, but not every time. Okay. Oil is literally, as I say, I mean, I covered this last time, but I think you probably will drip to this point. And I'd much prefer it long, $74 area. The sentiment for oil is improving to the upside. Okay, you can see your stochastic oscillators coming into oversold, so you definitely don't want to be short. I know I said it will. I think it will fall, but I'm not interested. It doesn't mean we're selling. It just means there's a good chance that'll happen, and I would rather buy there than here. This can break through. I wouldn't be surprised if it does. But naturally, if I sell, I'm too late. I'm far too late. We hit on this 200 MA. Okay, $83. We look short, and we're out. Okay, we don't want to sell again. It's no good into a level like that. There's loads of guys in here just coming in. Welcome, guys. If you can hit the boost, that'd be fantastic. As always, underneath the video, you can get started. So crypto as well, a lot of people are asking me about, and it's just because the market's now moving. This is not a good buy for me, and just use your brain early. Look, the market comes up and it's hit away immediately. That tells you that there isn't strong bias to the upside. Okay, so you can see as well that candle has got a heavy bottom side and it's pulling down. So if you were going to buy it naturally for market value, I'd far prefer it down here. Okay, that's where I would prefer longs, and I think you'll get there. But again, don't short it, don't sell it, just let it move, then get long. If you wanted to sell it, you should have done it up there. All right. Plus, crypto's a HVA, so you could get blasted on the short side. I don't really like the idea of shorting crypto. Only really I would trade it long. FTSE, in case anyone's interested, I'm still short. My bias is short, and I'm hedging to the long side. Euro yen short. S&P futures. It's a bit uncomfortable, that movement, really. I like it near a 4050. Okay, so you're going to have to drag near this 200 MA as I label. That's my preferred long zone, and it's just because if you flick onto the daily, you've got this upwards channel, and the midpoint of that is going to lie around there, and there's a bunch of PA zones. So I much prefer that for longs, and I'll do it mid-size, okay, because the price isn't incredibly feasible. It's not low enough. More guys coming in. Fantastic to see you. Is there any specific trading questions, perhaps in regard to what I was saying before? If we flick back to that Swiss yen, okay, a really, really rallying market. Is there any questions about trading those endless markets, those ones that go up and up and up and up? Because this is something I focus and hone in on a lot. I teach people about risk management a lot because that has to be at the core of your trading. If you're trying to trade anything like this, you have to do it with a plan. You cannot just guess the size you want to trade and hope it goes fine. Okay, because it won't. There's no plan behind that. There's no methodology. There's no accuracy, and it just presents danger. Okay, and you don't want danger. It hurts financially. So yeah, any questions under here on YouTube or in this live chat, if you can. In terms of charts that are similar to the Swiss yen, we'll touch on gold a bit. You can see a similar thing happening with gold. You're getting that rejection, but there's very early rejection from early support. So if I swap to my daily, we spoke about this. The fall is coming to a place where you've already hit very recently, and that's why you're not driving through. You need a news event that says, wow, let's short gold to bring you down and down and down and down and down. Okay. Until you get that, you're probably going to dawdle along. Nonetheless, I don't know for sure the exact dollar amount that it's going to stop at, but anything higher, I'm going to trade naturally. I'm going to get short at a point that is short. Or in other words, I'm going to get short where it previously fell, because that is the only information I can go on. The only factual information I can make a decision based on is what's happened before. And it's the same in many cases. It doesn't have to be trading. Okay? How many times does something happen? You touch a pan that's hot and you don't do it again because you've learned from past experience. Okay? And it's the same. To be honest, it's quite funny as well as an analogy. It's similar to touching that hot pan if you're buying at highs. And I'm sure many of you touched the hot pan before and got a sore thumb, a sore finger. It's about using that past experience and learning from it. And you don't actually have to get things wrong to realize that. The only information you can make that judgment on is previous price action. And that's all you need to do as a trader. But within that, you need proportional size to your risk. You cannot get short here with your whole account equity on the line. If you go to $2,100 per ounce and it ends your account, you will never make money trading. Never. Okay. If $2,200 is too far for you, you'll never make money trading because you're always going to bust out. Eventually, it doesn't matter if you got the full right. If your risk still is too high, you'll lose money next year. If you make money on this trade, you'll lose it in a few months. If you make a ton of money, let's say on a fall, and your risk is rubbish, you'll short it again, and the next time it won't go your way. It's like betting on a horse, $10,000 at 10 to 1, you get 100 grand back, or 110,000 because you get your 10 grand as well. But then you do it again. But next time you lose, and 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 you're out. Okay? So just remember, make judgments on what's happened before. If you've seen it happen before, you're looking short again. So is there any more closing questions here? I think a lot of guys are liking or following me. That's great. Do press follow, guys, because you'll know when I'm next here. But you can stay more local if you go to my Discord, or if you get on board the Academy, you can do that. There's tons to learn. You can just learn to trade sustainably like I am on the FTSE. Okay, it's no different. It doesn't matter the market you're using. It really doesn't. Any market, same method, because the markets are the same no matter what. Okay, the only thing that needs to change is your risk based on the asset and based on your equity at the time. Okay, how far has the market gone up and what are you going to do about it? If you're trading the Swiss yen, how much longer can you trade it before things get too much? Can you trade it forever because your risk is accurate? You've got hedging rules, you've got DCA rules, you know when to be in, out, you've got an accurate size. You understand that this is not a big long. It's overbought clearly. Okay, it's all sorts. So as we go into the week, you've got various banks around the world putting out earnings. That may move things, but just manage your risk, guys, accurately. That's the secret. On MT4, how would one trade the Dixie? One needs to focus on the euro and the dollar yen. The second part, Chris, yes, that's correct. The first part, whether you can do that it's specific to your broker, more or less. But I mean, people do get very confused with the Dixie and the euro and the dollar yen and how it affects the whole market. Just understand that the Dixie, okay, is basically the euro flipped upside down. So whether you're using the Dixie or the euro, it doesn't matter. The dollar index just gives you the value of the dollar. But I mean, it's okay to check it here and there to get a general understanding, but I would focus, as I said, on the individual pairs and split your risk according to the amount of money you've got in your account, or your equity at any time. You don't want to trade too large, just split it between every pair. So yes, you would trade individually on those FX pairs. That's right. And as I say, if you want me to touch up on the other question, just let me know and we'll get you sorted in Discord or something. So thanks for watching, guys. Half an hour there. Excellent. I'm going to post this onto YouTube. As always, if you want to get trading right, you don't want to over leverage, you want to know how to trade those runaway markets, just go to the link under the video. It's in my bio of my TradingView account as well. http ://goldstreet.io. That'll get you set up. I've got indicators to track markets for you, full rules on everything, video training, the lot. Okay, it's all there. So go ahead, jump in there and chat with us on the Discord if you choose to. And I will see you next time. Thanks for coming, guys.